Morning, ladies and gents. Simon Brown here doing intro for Warren Peacock. Let's just check that you're hearing us, that you're picking up the images and the audio. If you are, you could raise your hand in the GoToWebinar application. Brilliant. Hands coming aplenty. So as always from Warren, this is our third of the series in terms of introduction to trading FX on Webtrader. Warren will do a bit of a sort of education learning stuff and then some signals, but I'll hand over to Warren. We're about 15, 20 minutes, and then certainly we've got time for questions afterwards. Warren, with that, over to you.
Thank you, Simon. Morning, everyone. Welcome to part 3 of our introduction to Forex trading. I just thought I'll take a minute to recap last week's idea. We had the British pound to the dollar firing a buy signal on the moving average crossover, and it had broken the 4-hour resistance level, and we have a result. The current chart, you can see that the pound has pulled back against the dollar. Basically, the stop loss, you can put it either on this neckline, so some support over there, or if you are a little bit more relaxed about it, you can have that interim support level as a new stop loss area. The expectation is as long as the 21 is above the 89 that the trend is up, and we would be looking to the 4-hourly chart for the next trading idea there, or the next signal, and we'll just have to see how it works out. Remember, these trades are pretty much long term, and if this one does work, you could be holding it anything up to 18 months. So just be relaxed about it and watch your money management, please. Today we're going to have a look at hourly charts, and we started off with dailies. In the first session we looked at 4-hourlies last week. And today we're going to have a look at the much smaller time frame on the hourly. And here it's a little bit different. We still apply the 21 and 89, but we add in the 8 EMA. We place that on the hourly charts. We use the principle of the daily trend for direction. So that daily trend is still paramount, it's still important. And I'm only looking to trade the hourly in the direction of that daily chart. The hourly chart does require a lot more focus, a lot more time to trade properly. So I suggest trading them only when you actually have enough time to do so. You have to watch them, and you could be watching them for 2 or 3 days, as we'll see in the example I've put together for today. You could be watching for some time before the trigger actually comes in. And they also require a little bit more technical know-how, actually quite a bit more. You need to know your channels, you need to know chart patterns, candle patterns, and your support and resistance has to be up to scratch. The hourly chart can move pretty quickly, but it also moves pretty slowly, so you have to be quick and patient at the same time. What I put together here is a US dollar CAD trade that came up on the hourly chart. If you have a look here, the vertical line is when the daily trend changed from up to down. And then we just applied the 8 moving average, which is the green line. We still got the 21 in blue and the 89 in red. That daily trend changed from up to down, and I then apply the 8 and 21 crossing. So 8 crossing the 21 downwards because our daily trend is down. The trigger came in at the red arrow over there. We can see that the 21 crossed below the 89, and what I did here is I just take the parallel channel or the equidistant channel, drew it across the bodies. I don't like to use wicks too often in currencies because I'm looking for a close always. And if the previous body is at that level and the current body closes below that level, I find that slightly more important than waiting for the wicks. So I just drew in a parallel channel, and we can see that I drew the line in at the top and took a parallel down the bottom, and there I just put it on the wicks. That made a little bit more sense because we had that one didn't quite reach, that one didn't quite reach, this one broke through. So on the top, body to body, and then extended it down, I just put it on the first wick, and that was just to get a parallel channel to see what happens when the averages cross over. And we can see when they did cross over, price was actually sitting on that lower channel line. That's enough on the hourly chart for me not to make the trade. So now I'm going to wait until a lower level is broken or the moving averages cross up and then down again. So always just be aware of all the other technical stuff you know when the averages cross over. The two circles show, so that is where we were first looking at it. It didn't quite close below it. This one closed below the channel, and the very next candle gapped higher and right back into the channel. I'm really not interested in gambling, and to me that was a failed break, and I'm not really interested in being short. But what occurred a couple of hours later is the two circles show us a double top, and with all candles I draw it on the wick, on the bodies and on the wicks. I get a little zone, so that's the resistance zone. The market came up, formed a double top, and then created a bearish engulfing candle. If the EMAs cross down, then I shouldn't have any problem implementing the trade. Okay, I've got the bearish engulfing, that's an early trade signal. Aggressive traders would be short over there with a stop loss just above the channel. And if the moving averages cross over now and everything else is clear, I shouldn't have a problem trading the short. Got the double top, got the bearish engulfing, and I'm ready to go short when those averages cross down. All right, here's the second cross on the averages, the big red arrow over there. EMA's cross at the red arrow, but the price is now on horizontal. So again, I just took the lowest body and then the second lowest wick. These spikes are generally irrelevant. I don't use them for support and resistance when it comes to actually entering the trade. I might use them as a stop loss or something like that. But really, I'm interested in actual market pricing. And we can see the average has crossed over, and now we're sitting on horizontal support. We hold on to that early short, so we're still holding that short. And we're waiting for another signal, either the averages cross up and down again, or that support level is broken to the downside. And we can see here, we have the market finding support and actually pulling back a bit to the top of the channel. It took 19 hours eventually for the price to break below support. Okay. At the same time that was happening, you'll see in this example I now removed the 8, and that was just to show how the 21 is crossing the 89, which is a really strong signal that that support line break is important. An important support level is breaking. The double top with the bearish engulfing pattern got me in early. The 8 already crossed the 21, and it is just hovering in the middle here. The 21 finally crosses the 89. Strong signal that momentum is likely to continue in the direction of the crossover, which in this case is downward. Support line is broken, and that would be my second entry point. The stop is placed above the previous swing high, which is this level here. I didn't want to draw too many lines in on the slide, so that little red arrow depicts the high. Stop loss for both trades would be just above the midpoint of the channel. If you do know your technical analysis, midpoints are normally a pretty good place to put a stop on a support level break. That trade there would still be positive at the stop level. This trade here would be a loss, and it won't quite make up the profit of the first trade, won't quite make up the profit of the second trade, but it'll certainly mitigate the loss. So I'm quite happy to add into a winning trade on a classic technical, for a classic technical reason. So we have 21 crossing below the 89 direction of the daily trend. We have the support level breaking after a double top and a bearish engulfing candle. So all your technical analysis knowledge has to come to bear on an hourly chart. If we just trade moving average crossovers, you're going to end up with whiplash, and you're going to be rather upset at the end of the year, because I don't think you're going to be profitable if you just trade 21 crossing 89 on the hourly. You have to bring everything else into play. You have to look at where support is. You have to look at resistance, your candle patterns. You have to look for channels. And the other thing that I just want to mention here is this channel was broken at that point. Okay. When it broke back into the channel, that is classed as a false break. Again, another bearish signal. So the weight on the short was actually quite immense. There were a lot of reasons to be short. I just don't want to rush it. Okay, so I wait for the support level break. I've got an early trade up there. I'm quite happy just to wait for support to to give way. On the next chart, I've got some alternative look at this particular move. The price is broken below support over there. It's closed below. We enter the second trade. It then breaks below the channel in that area. That shows momentum. It proves momentum has increased. I'm happy in my two short positions. I wouldn't enter another short on a downward sloping channel. Okay, because by the time the price gets down there, my stop loss has to be quite a way up. Not interested in trading short on a downward sloping channel. What happens then, the market falls lower, it then pulls back to the lower channel line, and at the same time, the action has formed a bear pennant. Now, that is quite a solid continuation pattern. I use it on pretty much everything that I trade. If I do see a pennant, I assume it's going to be a continuation, but I do wait for the break. So that big red candle breaks the pennant, short at the next candle open. You now have 3 positions in on the hourly chart. Obviously, if you're a nervous trader, you wouldn't be adding into 3. You would probably have chosen one of the other 2 signals, maybe at the double top or break of that double top neckline, which was that support level. So this is the most likely trade for beginner traders or those guys that are maybe not so aggressive. If you're an aggressive trader and you're looking for as many trades as you can get in the direction of the trend, you'd be short on the double top, break of support, and then this pennant pattern confirmed at the channel resistance. So the one thing that you can note here is I haven't deleted that channel, and it remains important until the price actually disproves it. So at some point in the future, that channel will become irrelevant, and normally I would consider that if price has moved a very long way away from the channel or is maybe reversing and I've got a new channel to draw. So when the pennant broke, another short could have been entered. All 3 stops would have been placed at the high of the pennant. Okay, so standard technical analysis applies here. All 3 positions would have had a stop there. That is my new swing high, and I am riding momentum, so I don't want the stop loss too close. In other words, break back above that level I would consider too close. Really looking for that pennant to be broken, confirming that the trend is changing direction, and that would probably have occurred before the averages cross over in this price action area. Banking profits. Stop losses are more than just protecting capital from serious loss. Stop losses are also used to bank profits. So this trade worked out very nicely, and then what we saw down here is volatility coming in. Now that volatility is not so much that we've just got long candles like we had previously in this area here. This volatility is actually in a consolidation type pattern. So as soon as the market starts to give me this, I can't see it in those first 3 candles. I'm not going to say that that's volatile. By the time that level has occurred, then I can see volatility. The price that comes lower, it breaks the fib level, which I'm going to cover now. I can confirm volatility at this area. Okay. So once I start to see volatility occurring, that first area, I draw a fib from the top of the consolidation and to the bottom of the consolidation. All right, so my fib is between those 2 lines. And I run 2 extensions. I use a 161.8 and a 261.8. When the price goes volatile like this, I put the fib levels in there as a target opportunity. Now, I'm not trading the targets. I suppose you can. You could put an exit over there. You could put an order in to close out your positions. I just want to see what's going on with the market. That volatility occurs. I see that it's on a 261.8 extension of the consolidation. So that was that double top. Okay, and I look there for potential turning points. I just want to delete. Where can I delete my erase? Okay, let's just delete these drawings so we've got a clear picture. All right. Now, from there, I can draw in the fib, I get the extensions, I can now start looking for an exit point. At this point is where I drew the fib in, because I can now see volatility. My stop loss would have been trailed to that level. It didn't break initially. The market continued lower, broke below the fib. Okay, now I'm quite excited because I'm below the fib extension, and it's quite possible this could have carried on for a couple more days. In this example, it didn't. What happened is the market came and created a big green candle, proving this to be a false break. So a false break lower, I'm not interested in holding my short for too much longer. All I did is I dropped the stop loss to that horizontal red line, which covers the bodies, and it's called, I call it internal resistance. It's not an upper level, it's really the neckline of this consolidation. If you really used your imagination, you can see a left shoulder, head, right shoulder. I wouldn't call it head and shoulders, but the neckline idea comes into play. And as soon as the market closed above that neckline, notice that the body closed, but below the wicks. So the candle closed there, but above the other bodies, but not really above the ultimate wick. That is enough for me to get out. As I was saying earlier, the actual bodies are much more important to me than the wicks, especially on stop losses. The open of the next candle is your exit, so somewhere at that level is where I got out. And we can see the market then continued higher into the 89 moving average. All right, so the first point here was the 161, price broke straight through it. It then reversed above it, gave me a little evening star, and which is one of the reasons I held on to the trade. As it started to move up, as you know, Steve Nissen calls this market rising in agony. It's got wicks and dojis, but it's still rising. It never really closed emphatically above that resistance level. That was not a very strong retracement. It wasn't a reversal pattern. Okay, so 161.8, I didn't exit. If this had occurred on the 161.8, I would have probably been closed out. It's a bullish engulfing on 161.8 would have been support. I would have probably closed the trade. Okay, but in this example, didn't. It followed through, hit the 261.8. I start to get a little bit nervous, and I'm looking to exit. Gave the market some space to move, drew an internal resistance level, price closed above that resistance level. In the next candle as it opened, I'm looking to exit. You obviously don't get exactly at the open, but somewhere in there, could have been out of the trade. So we can see the hourlies require a little bit more knowledge, a little bit more intensity, and quite a lot more focus. Even though each candle is only an hour long, the focus is required, but now for a couple of days, and it can easily be 24 hours as you're waiting for this consolidation to decide what to do. Once the pennant broke, 261 became important. We can see that price went volatile after hitting that level the first time. Sorry, I did cover that a bit earlier. The red resistance level became obvious after the false break. There was the false break. When price closed above that resistance, we exit the trade. So in a clearer picture, it looks pretty simple. It can be a little bit difficult to implement. So just take it easy. Now the results of those three trades, the first trade from the bearish engulfing at the double top was 150 pips profit. Trade 2 was 88 pips. That was a break below support. And then trade number 3 is a break below the pennant. There's 27 pips. And even if the last trade was a loser, let's say it had been negative 30 pips, which was the top of that pennant, you would have still been profitable on both the other trades. And that's why I like to pyramid into winners. But I still only want to do that with really good, confirmed, straightforward signals. Unfortunately, there were no trading opportunities today that I really saw. The currency market's a little bit topsy-turvy at the moment. Dollars is weak on the longer term, but getting stronger on the short-term charts. So no real clarity on direction. So I haven't put in a call today. I'll just have to wait and see what the market does. Hopefully next week we can get one last trade in. Points to ponder. So when you want to look at an hourly chart to answer these questions, do I have enough time during the day to watch for the triggers? Because you can see that bearish engulfing, it was only 2-hour period. If you came back on the 4th hour, you would have missed it. If you had waited for support and missed that 1 or 2 hour break, you would have missed it. The next question is, do I have enough capital to trade multiple positions? So you've got to check your stop losses. Do you have enough technical analysis knowledge to trade an intense environment? How do I feel when I look at the chart? So if you look at an hourly chart or you look at your trading opportunity, do you feel anxious, excited, or stressed? Any one of those three is an indication that you should probably practice a little bit more, continue to trade small. If you feel stable, you're probably ready to get involved. Feeling stable will normally come after a couple of months or years even of actually trading. So you trade small until you have very little emotional response to the charts. All right, so that's the one you want to work towards. Thank you, Simon. Any questions, guys?
Thanks, Warren. Folks, if you've got questions, drop them in the Q&A box. A couple coming through. Kaputsa's asking, so some of the questions come in before you hit the point in the presentation, but asking around trailing stops. Warren, are you always putting a trailing stop in the place?
I try to. I won't claim I'm perfect. I just do find that my trailing stops give me much more of the run than if I trade on targets.
Gotcha.
So if my first target had been 161, I would not have caught the 261 extension.
So are you pretty much getting out on the stop?
I'm getting out on the trailed stop.
Yeah.
I just trailed it with that resistance level, closed above that. I'm out after it hit 261.8.
Stefan's asking if you would use stochastic as an extra indicator.
I don't, no. I like my price action and my patterns.
His second question is, would your trend fishing system work on a slower chart like the 4-hour?
In my experience, I have tried it a few times. I gave up on it. It wasn't giving me good solid signal. So it would give me a signal and then the market would fall a bit more. So I kept breaking support before turning, and the trend fishing just didn't give me great trades.
Cool, fair enough. Another question coming through, folks. If you've got questions, drop them in the Q&A box. A question coming: what techniques or studies could one use to help determine if a trend is losing momentum, signaling to get out of the trade?
Okay, one of the signs is a false break, as we saw in that 261.8. The market breaks below support and then bounces above it, cancelling out that that support line break. The other one, patterns, rising bottoms. I don't think we had an example on this presentation. There's a small rising bottom at that level, not great, okay, but rising bottoms can be a good indication that markets are losing momentum.
Mm-hmm.
The other thing is the moving averages can pull so far apart. In the old days, we had an indicator called OBOS, which would measure the distance between two moving averages. Mm-hmm. And if that gets to an extreme over the average of that chart, then that could be a sign, similar to like you'd use a stochastic, oversold or overbought. If the distance between the two averages gets to a large degree, that would be a sign that we might be in for a momentum change. The trick would really be, the thing is, if you could predict the change in momentum so easily, then money would be really simple to make. So it's really an experiential thing. Candle patterns can give it to us on higher time frames, but I do like the idea of the rising bottoms and a internal resistance level break. And that's normally a good sign that the market's going to reverse. It doesn't mean that the trend will change, but it does mean that you're going to get a bit of a relief rally.
Deepak has, as he says, not a question, but a comment. He says, cannot emphasize the value in using stop losses contributes one's emotional stability. Deepak, I agree 100%. To me, stop losses are two things.
Absolutely.
One, in fact, stop losses are three things for me. One, they reduce my risk. 2, they remove me from the process and my emotional roller coaster ride. And 3, I do the same as Warren. I exit on stop losses. So, Deepak, couldn't agree more. And I'll say it again, cannot emphasize the value in using stop losses, contributes to one's emotional stability. And there's no point in making money, but being so stressed, we can't get to enjoy it. Trading's about finding that comfort space, I suppose, in a sense. Ladies and gents, I'm not seeing any more questions coming through. We have recorded. The video will be mailed out in the next couple of hours. It will be on Webtrader and Standard Online Share Trading. And then we are back again next Tuesday for the last session this week, again, 10 a.m. Warren, really appreciate your time. Ladies and gents, thanks very much all. Cheers.
Thanks, Simon. Cheers, guys.